the traditional custodians of the various lands upon which we meet around our country today, and to pay our respect to elders past, present and emerging, recognising their ongoing cultures and connections to the lands of this country. Before our broadcast begins, please also be advised that all of the information provided today is general in nature and does not take into consideration your objectives, financial situation or needs. Before making any investment decision, you should always seek independent and licensed advice, which takes into account your specific circumstances.
So thank you very much for the opportunity to present today on Prime Financial Group. This is our investor presentation. My name is Simon Matter. I'm the Managing Director and Chairman of Prime Financial Group. So firstly, let's start by talking a little bit about what the firm is and what we do. So we're a market-leading advice, capital and asset management group, and there really are four key services that we deliver to our clients in a very integrated way. That includes wealth management, capital and corporate finance, accounting and business advisory, and also SMSF services as well. And we do genuinely believe in uncapped opportunities, and we are very much committed to creating prosperous and sustainable futures for everyone. We currently manage about $1.1 billion for our clients. We have over 150 team members that are supporting the development of our clients and their businesses. And just touching on that in a little bit more detail, we are actively working with emerging companies, high net worth family groups, and also wholesale investors, and trying to find them some interesting ways to invest in alternatives and also property as well. We do have a global footprint. Our clients are growing, we're growing with them, and we're seeking to deliver services in a very integrated way for them. I've mentioned our four service lines, and importantly, we have been around now for 25 years and celebrate our 25th year this year. In terms of what we do, and let's break that down into a little bit more detail about our business. As I said, the key is not just having four important service lines that support the development of our clients' aspirations, but it's how we go about doing that. So in terms of our wealth management business, we are delivering to our clients anything from strategic financial advice to investment opportunities. It can cover superannuation, non-superannuation, and we have a fantastic dedicated team there of 25 people that are managing that current $1.1 billion of funds under management. Wealth management makes up about 30% of our overall revenue. In terms of capital and corporate finance, we are working with those emerging businesses that are seeking equity and debt capital solutions. We're helping them out with M&A. Occasionally we're selling businesses as well. And we're also doing, I think, a really important thing by assisting those businesses around their ESG and their impact within their business. 20 fantastic team members that now currently make up about 20% of our overall group revenue. In terms of the accounting and business advisory aspect of what we do a lot of traditional accounting, tax and compliance work for those emerging businesses, but we really add a lot of value around their growth advisory piece. We'll also assist them with their virtual CFO so that they're getting the right information at the right time to continue to develop their business. But one area where we really do differentiate is around R&D tax incentives. There's over 600 companies that we assist to access that tax incentive, which is an important part of their own individual growth trajectories. 50 team members, 36% of our group revenue, and again, another growing part of our business. On the SMSF front, we do assist people to establish an SMSF. We give advice, but also we offer a really important service, not just for our own clients, but for our accountants and financial planners that want to deliver a compliance and administration service as well. There's over 200 accounting and financial advice firms that we assist to deliver this part of the advice stack for their clients. Importantly, as we're trying to deliver this totally integrated solution across all four of these areas, we've got a fantastic centralized shared services model that allows us to scale and also develop the right EBITDA margin within the business. So shared services for us are finance, IT, HR, marketing and operations. 20 great team members that are working consistently every day to develop the overall business so our clients get what they need and our team are absolutely supported. So why Prime? Why do people choose Prime? And again, I'm going to keep coming back to this key thing. It's not just the four services that we offer, but it's a way that we integrate them to help our clients achieve their aspirations and their ambitions. So we have a strong team focus. That 150 team member group are all becoming owners in our business. 45% of our business is actually owned by the team, our most valuable asset. They're proactive. So we're thinking about the future. We're discussing what's important to our clients. We're leveraging that relationship, that trusted relationship that we're gaining, and we're finding better ways to do business, better ways to advise and help our clients grow. And importantly, we're accountable, not just in terms of what we say we're going to do, but the impact that we do make in the communities that we actually operate. Very pleased to say that over the last 5 years, we've developed a really consistent record of delivering value. What you've got listed here on this slide is underlying EBITDA, after-tax earnings, basic EPS, dividends per share, and also share price growth. And what you're seeing there over a 5-year period of time is the fact that we've been able to achieve compound annual growth rates between 20% and 39%. The strategy that we've got for growth in supporting our clients and our team is working really well. And we're carving out a very nice niche within that high net worth family group and emerging company space. So we are very growth orientated ourselves. We've got a fantastic business that is growing, and we did say back in FY22 that we wanted to increase our revenue from $26 million to $50 million in FY25. So almost a doubling over that period of time. And I'm pleased to say that we're on track to achieve that. But recently, we did also talk about increasing that again and trying to double over the following 3 to 5 years into FY28 and FY30 to around about $100 million. So we want to scale, do it prudently with a great team that own part of the future they're helping to co-create. But we're going to do that both organically. So that's the 4 services that we've currently got now, plus also finding new people with existing client bases that would like to join us. We'll roll out new services, and we'll also undertake acquisitions as well. Some of the new services that we rolled out in the last half of FY23 included debt capital advisory, ESG consulting. Not only do we have a lens ourselves in terms of the impact that we make, but we help other businesses think about how they make an impact for the future. And we've also expanded our wholesale investor service as well. We did also complete our first acquisition in 6 years, and we completed that in October of last year. And that really continued to build our capability around SMSF, its administration and advice. So we'll continue to prudently look at acquisitions, but we are an organic growth-driven business that is complemented by acquisitions that allow us to do even more for our existing client base. Some of the financial highlights for FY23, absolutely worthwhile highlighting here, is revenue growth of 28%. 19% of that was organic and 9% from acquisition. 11% increase in underlying EBITDA, a 26% EBITDA margin. Our EPS was up 15%. Our dividends were up 36%. We pay out anywhere between 50 and 70% of our earnings. Last year, we paid out 68%. Our debt is currently 1.1 times underlying EBITDA. So a very strong year. And again, what you're seeing here is the revenue growth and that trajectory that we've had, particularly in the last 2 to 3 years. We had 18% organic revenue growth in FY22 because there were no acquisitions in that year, and then 28%, of which that was broken down in FY23, 19% and 9%, as I mentioned before. Encouragingly, 80% of our revenue is actually recurring in nature. It allows us to make longer term decisions. Our customers return every year to get additional services from us, and that allows us to make those long-term decisions about the growth of the business. In terms of revenue growth by each service line that we've got, I'm pleased to say there's really not a part of our business at the moment that isn't growing. Our wealth management division grew by 15% last year. It grew our capital and corporate advisory division by 42%, and our accounting and business advisory 14%, and SMSF up 102%. That included the acquisition completed in October of last year. So all around, the existing service lines are growing, but there are more people wanting to join us that want to bring an existing customer base, that want to become owners in this business. There's more we can do for our customers. We will roll out more service lines. And as I said, selective acquisitions as well. So in terms of our strategy for growth, it is really as simple as what you've got here, 1, 2, and 3. Top line growth. So that's how I've just mentioned we will go about growing the business. margin expansion, so continuing to find higher EBITDA margin services that are very complementary in terms of what we can do for our clients. Leverage that centralized services structure so we can get back to a 30% EBITDA margin. As I mentioned, 26% in FY22, as FY23, I should say. And we do have a funding capability. We are funded by Westpac Bank. We have about $10 million available on our acquisition facility, so we can continue to grow the business via acquisition in a complementary way. As I mentioned before, we are committed to the impact that we make as a business. We do have our own ESG strategy. I am pleased to say that there are 4 key United Nations Sustainable Development Goals that we are focused on: gender equality, industry, innovation and infrastructure, a core part of how we think about the future for our business and our clients, climate action and partnership for goals. We partner with those accounting firms and with those financial advice groups to support them as well. In terms of our commitment to ownership, I have mentioned this a couple of times, but this is a really important point in terms of differentiation for what we do. 45% of the business is owned by the team, and once a team member has been with us for 12 months, regardless of where they've come into the business or what level they're at, they start earning equity in the business they're helping to co-create. It's a really key point of difference for us. So in terms of our outlook in FY24, we'll continue to have strong organic growth. We will look at accretive acquisitions. We do have the funding capability to do that. We'll continue to scale our business and become more meaningful, make a bigger impact. And in terms of FY24, from a revenue perspective, we expect that to be up 15 to 20%, EBITDA 10 to 15%, and dividends again up 5 to 10% for the year. So if you're going to make an investment case or highlight why it is that you look at Prime from an investment point of view, you look at the strong track record of earnings that we've had, that 5 years that we talked about in terms of between 20 and 39% compound annual growth. You look at the revenue and the fact that we've been delivering on that revenue growth. We do have an M&A strategy, which is complementary, not core, but complementary to our organic growth strategy. And we do pay fully franked dividends. We pay out almost 70% of our earnings, and we do have a robust earnings outlook. We've got a great team. We're delivering a fantastic service. We're in a great industry where there's a lot of opportunity to deliver more value, and we continue to carve out our place within that. Thanks very much for your time. We've appreciated the opportunity to present to you today.
Good morning, everybody, and thanks for being here and listening to my presentation. My name is Riccardo Canevari, and I am the CEO of Radiopharm Theranostics. So, of course, our disclaimer first, but let me share a little bit about the company. So, first of all, we are in an important market that is in oncology. We are in solid tumor, and we do something very specific. Our ambition is really to successfully fight cancer, leveraging the innovative mechanism of action of radiopharmaceutical therapy. Radiopharmaceuticals are a very innovative way of treating cancer beyond the typical approach that it is surgery, targeted therapy, chemotherapy. Now there are emerging radiopharmaceutical therapy that are showing very positive efficacy and also a very positive safety profile. So this is what we do. This is our core business, and we do try to differentiate ourselves versus other companies that are in this space. First of all, we do believe we have a unique business model, extremely high resource allocation to R&D, so preclinical and clinical trial, very small resource allocation to internal cost and G&A. In general, we are a small team of 11 people, and our business model is really to coordinate and work very close with important partners. And I will show a little bit more about this later. We do have our own molecule protected by patent. Some of those will go well beyond 2040. Our molecules are different from the ones that are in development from other companies. As I mentioned before, in this unique space, we have unique mechanism of action to target and potentially treat some important solid tumor where there is high unmet medical need. The team is small, as I mentioned, but we do have a lot of expertise. Everybody as the opportunity to work in the past, either in imaging diagnostic or in therapeutic or radiopharmaceutical. And we have a large network of key opinion leaders that we can reach out at any time. And based on our pipeline, we really expect that in the next 3, 6, and 12 months to have a lot of news for the market. I mentioned before our unique business model. So instead of building brick and mortar facility, R&D, hiring people, we decide to leverage the expertise where it is. For example, we are in nuclear medicine, so we need isotope. And we do have collaboration with very important global players for our 3 isotopes, lutetium, actinium, and terbium. All of them are producing and delivering single doses to us that we can deliver to the patient without creating our own facility for such an expensive distribution of products. In terms of pipeline development, we do have important agreement really with the top center in US and in Europe. We have a joint venture with MD Anderson. We have an agreement with UCLA, with Case Western University, and with the Technical University of Munich. And of course, as we need to progress our program in preclinical and clinical, also we have strong collaboration in the area. And I would like not to forget that we have an important agreement also with a company, Lantheus, that is an important player in the space. So this is our approach, and thanks to our approach, we are able to bring to clinical stage 4 assets. 2 of them on top, these are imaging, and the 2 at the bottom are therapeutic. Our first priority is Pivalate, is an imaging agent for patients with brain metastasis. We have already concluded phase 2A, and we are in discussion with the FDA to start a phase 2B trial in US soon. So very advanced late-stage development. And then we have other 3 technologies that are expected to start phase 1 extremely soon. The first one in pancreatic cancer is an imaging agent. We receive IND approval, and we plan to have the first patient potentially next week or the week after. And then 2 therapeutic. The first one is a therapeutic agent for patients suffering from non-small cell lung cancer. This trial has been approved to start in Australia. We will dose the first patient before the end of this year in Brisbane at Princess Alexandra in collaboration with Genesis Care. And our 4th and last priority is a therapeutic products for breast cancer, HER2 breast or gastric cancer. So 4 trials, really an important moment for the company to transition from being a preclinical to become a clinical stage company with multiple assets. And with those programs, we do expect a clinical milestone to happen soon. I mentioned already that in Q4 of this year, so before the end of the calendar year, we expect the transition of all our 4 priorities into a clinical. That is absolutely great news, of course. And if I can say even more important, not only start, but we have 2 trials that we believe are going to read out and present data before June of next year. The phase 1 in pancreatic cancer and the phase 2B in brain metastasis. So as I mentioned before, a lot of news expecting in the next 3, 6, and 12 months. As a company, as a team, we are fully committed to bring innovation to patients suffering from solid tumor. And this is an exciting moment for us of transitioning the company where we can really treat patients and hopefully to see very positive results. And with this, I'd like to thank you for your attention. And yeah, thank you for listening.
Good morning, everybody. I'd like to take this opportunity to present Gratify's Q1 quarterly results. It's been a very strong quarter for us, and I look forward to what we've got happening for the rest of the year. Okay. So we've had a strong quarter of cash receipts with 7.27 million, which is up 32% on prior corresponding quarter of Q1 23. Our operating cash flow improved by 52% from negative 0.6 million to negative 0.29 million. We have $1.37 million in cash at the end of the quarter and a 2-year CAGR to the end of the quarter of 103%. So, yeah, we're very pleased with where we sit at the end of the quarter. If we look, September is traditionally one of our slowest quarters, but the numbers were actually only down 4% on Q4, which is one of our stronger quarters. So we certainly carried forward momentum from the last quarter into this quarter. We're showing, consistent growing revenues now, and we expect that to continue for the remainder of FY24. We see the cash receipts results as a culmination of a number of factors. We're growing the number of participants on our products. We're growing the range of products and services we offer. And that's across both existing clients and new clients as we sign them up. We also believe that rewards is a counter-cyclical business, and that when times are tough, people look towards discounts. And I think that's been reflected by another number of other listed companies in the counter-cyclical discounting space. They're showing strong revenue numbers as well. During the quarter, we also accelerated our development, as we previously announced, in order to deliver phases 1 and 2 of our RACV project. And I'm pleased to say, as a consequence of that accelerated development, we're expected to see the first revenues flow from essentially today onwards. And that should continue to pick up through Christmas and into the new year. We're moving towards, as we've said to the market before, becoming cash flow positive sometime in the second half of the financial FY24. And we're using the working capital we recently raised to ensure that we're able to maximise our investment and pull on the platform and pull forward revenue as soon as we can. Our model is very attractive, as I said, in these tough times. We have over 16 million users on the platform now across our 35 enterprise clients. Essentially, at the moment, we do movie tickets, experiences, attraction and gift cards. But excitingly, we're moving into travel and dining. During this quarter will be our first forays into that as we launch new products to give us a broader range of products for our enterprise members and employees. As I said, Q1 of FY24 was a strong quarter for us, particularly as we continued on the number of users on our system and the new contracts that we've signed during the quarter. We've added RAA of South Australia, which is approximately 800,000 members, and RACV phase 1 is live with phase 2 to come. Seagrass continued to roll on new restaurants and restaurant brands. And excitingly, Cornerstone Health continues to grow with an additional 57,000 members coming on during the quarter to take their number of users to 230,000. So continued growth across all of our client base during the quarter. As I said, also operationally, we continue to add clients, but excitingly, we've also passed our ISO 27001 audit and expect the certification to come this month. We've been told everything is done, just waiting for the global certification. So we're getting a much stronger base for our clients. We're growing our revenue, we're growing a number of clients, and we're growing our customers. So everything is trending in the right direction for us. Looking beyond last quarter to the future, as I said, we've added multiple new clients recently, one of the larger of those being Club Connect, which has the potential to bring in an additional 3.7 million users onto the platform over the next 6 to 12 months, taking our number of people on the platform approaching 20 million users or accounts. And we'll continue to add products, as I said, with travel out to that large user base on top of what we're already doing. And we still continue to have a large pipeline of further new opportunities looking to come onto our platform. If we look at the indicative revenue run rate, going through from now out for the next 12 months, we can see revenue on the existing clients at a run rate growing from FY23's number of 30 million out to sort of 48, 49, 50 million over the next 12 months as we bring on new large enterprise clients, new product lines, and other client wins that we expect to deliver over the next 12 months. So things continue to go strongly in the right direction for us. As I touched upon, we've launched Neat Destinations, which is our travel product that we're doing in conjunction with RACV, and that will literally launch this week, and we'll start to make that offer out to our 35 existing enterprise clients, so giving them a broader range of products, and all the travel will be discounted along the lines of all of our other products. So focused on members and employees only, not B2C, but only to our clients on our platform. So expanding that offering, which we're very excited to move into. As I said, we're looking to launch 17,000 products on the site. There's a snapshot there of the actual site, which goes live this week. And we expect to see good revenue start to flow through that from our existing clients as they onboard the travel products on top of their existing products. So a very strong quarter and a very strong outlook for the next 12 months as well. More clients, our investments in infrastructure and our platform will start to deliver growing revenue streams, and we're bringing on multiple new enterprise clients. So the next 12 months is very exciting for us.
So thanks for the opportunity to present to you today. I am speaking on behalf of BPH Energy. However, the primary presentation focus will be on Advent Energy, but I'll speak further about our other two principal investments, which are in clean hydrogen technologies and cortical dynamics. I'm going to speak at length at the moment about the energy market in Australia. I'm going to take you to a slide of all of the onshore and offshore petroleum permits in Australia. When you look at New South Wales, you can see, in fact, that there are only 2 petroleum permits. That is the Santos projects in the north of the state and the Pepperleven project, which is in the Sydney Basin offshore Newcastle. The reason that I have that slide there is that Victoria, which has produced the bulk of the gas for domestic supply into the entire east coast of Australia, but primarily into New South Wales and Victoria, is in the midst of a 50% reduction in output, and this will occur by 2025. In context, Victoria has produced around 6 TCF of gas over the last 60 years in that process. And the prospective recoverable resource of the offshore Pty Ltd permit is 5.7 TCF. So if we're successful in the development of this project and the proving up of the project, then in fact we could, in that circumstance, be a solution to the entire East Coast gas supply crisis, and I'm going to speak to that in just a moment. So if we look at what's occurred in the federal sphere at the moment, Madeleine King has just introduced a future gas strategy consultation paper at the beginning of this month. Why is that so? Because decreasing gas supply faster than demand will lead to shortages, supply disruption and high prices, whilst worsening poverty and inequality. If we look here at one of the slides out of this consultation paper, and this is a key slide, we see that in fact the deep blue curve is supply under the current circumstances. The lighter blue curve across the top of the bar chart, the top of the graph shows around 1,800 petajoules a year of demand, and the supply within about a 10-year period is forecast to fall 800 petajoules a year short of the anticipated demand. Now, I'll give you context to that, and I'll do so in the following slides. But one aspect of that will come out very clearly in terms of either cutting entirely domestic supply or cutting export to the detriment of Australia. Here's where we look at domestic demand within the Australian marketplace. Northern Territory has 105 petajoules a year, New South Wales 125 petajoules a year, Victoria 230 petajoules a year. In other words, if we have an 800 petajoules a year shortfall, then in fact you cut out the entire supply into South Australia, Northern Territory, New South Wales and Victoria. That's how serious the current supply crisis is in terms of future gas supply into Australia. And here you're looking at manufacturing and domestic consumption. So can we rely on Western Australia to supply that gas? No, we can't, because if you look here at within the same time frame, the Western Australian supply is going to drop by around 200 petajoules a year beneath demand. And then if we look at the global LNG demand and supply over roughly the same time frame, this is a Rystad graph from current research. The red dotted line is demand and supply is in the black and green. So you can see that Australia can't rely on getting LNG out of a global network. Let's look back into the Australian gas usage, and the left-hand side of this shows you annual consumption in petajoules per annum, and this is the forecast on an annualised basis. The green triangles, however, show the winter forecast in terajoules per day, and this is right out to 2042. Even by that stage, if you're looking at an annual consumption, 300,000 jobs in New South Wales rely on gas supply, and it supplies around 1.3 million households. New South Wales now produces imports 98% of its gas requirements out of Victoria and Queensland. The pipeline capacity from Queensland and the north is quite frankly not adequate to meet that peak demand for gas. We have in the offshore basin area a gas phased basin, and that's the strength of the area. It's been recognised as a gas phased basin for approximately 20 years. Very important in terms of the sourcing of that gas supply. We have around a 20 square kilometre target in this area offshore Newcastle. It's about 30 kilometres southeast of Newcastle. Now I'll just move quickly into hydrogen and the cortical product. The strength of clean hydrogen is in the turquoise because it's produced from methane gas, and its real significance is in efficiency, water usage, which is zero, electricity significantly less than other alternatives, no CO2 emissions, and a very low space utilization. Cortical Dynamics, of course, has just received FDA certification, and we have an agreement with Philips, which is in, and the play screen is in about 50% of operating theatres on a global basis. The BARM system collects the EEG from the brain and expresses this in the form of two indices which are used in measuring depth of anaesthesia and analgesia. The analgesia component is what we're going through further certification through at the moment. So a short disclaimer, and I'll finish at that point, and thank you for the opportunity to speak today.
Hello, I'm Steve Whittemore, CEO of Immuron. We're listed on the ASX, IMC, and NASDAQ, IMRN. We have a technology platform for gut-mediated diseases based around bovine colostrum. Unlike in humans, where immunity is passed from the mother to the child through the placental wall, in a cow, this is passed through bovine colostrum, which is that first milk, which is rich in a number of factors listed on the screen. We take advantage of that cow to essentially be the drug factory for the targeted pathogen. And in the case of Travelan, that's E. coli. First, we develop a proprietary vaccine. In the case of Travelan, there's 13 different types of enterotoxigenic E. coli. And that becomes a drug product after we process it to remove the fat, most of the lactose, spray dry it, and compress it into a tablet. In Australia and Canada, we have health claims. And in the case of Travelan, that's for reducing the occurrence of traveller's diarrhoea, amongst other gut and liver benefits. Just having a quick look at the market potential for products using our technology. And in the case of Travelan, you can see that while last year we did $1.8 million in sales, up 136% on the prior year, in the first quarter of financial year FY24, we've already done 1.5 million. And this is even above pre-pandemic level sales. Sales are growing strongly as international travel continues to increase. This is a tailwind. And noted by the CDC Yellow Book, 30 to 70% of travellers to high-risk regions. So in the case of Australia, that's Bali, and for our American customers, that would be Mexico or the Caribbean. They experience travellers' diarrhoea. And Travelan offers them the opportunity to avoid getting it and to have a safe and healthy holiday. The market potential for Travelan in the US and Europe, as you can see on the screen here, is some $83 million and $50 million respectively, so large growth potential. We have a strong pipeline, a couple of internal programs. That's IMM124E, which is Travelan. For Clostridioides difficile, we have IMM529, and two partnered programs, Travelan in a phase 4 study with the Uniformed Services University, and Camp ETEC in collaboration with the Naval Medical Research Command, focusing on Campylobacter and enterotoxigenic E. coli. 3 of these clinical programs are funded by US Department of Defense grant funding, and that's the IMM124E, the Traveland USU study, and the CAMP ETEC study. We have a number of near-term milestones, anticipated drug value coming up in the near future. We just reported yesterday 50% of patients were enrolled in the second cohort of our Traveland controlled human infection model study. We're looking for top-line results for that study before the end of this financial year in June 2024. The CAMP ETEC program, which has FDA IND approval, we're going through the process of getting institutional review board approvals to start a phase 2 study, anticipated to start early in the coming calendar year. With regard to IMM529, this is a $1.7 billion market opportunity. We're looking to start a phase 2 trial in both primary and recurrent patients. The plan is to file a pre-IND with the FDA by the end of this calendar year, and to also manufacture a clinical product for the upcoming trial. The Traveland USU, Uniform Services University study that I mentioned before, is a large trial. It's 868 patients, and these are active US and UK military personnel in a placebo-controlled trial of Traveland, showing whether in these active military personnel travelling to high-risk regions, whether we can prevent travellers' diarrhoea. Thank you for your time.
Hi, my name is Matthew and I am the Managing Director of Global Health Limited. Global Health is a software company headquartered in Melbourne. We've been developing software for over 40 years across multiple industries. In 2008, we made the decision to focus exclusively on applications for healthcare as Global Health Limited, with a strong vision to streamline the patient journey and connect healthcare consumers with their care team. Today, we have a portfolio of software as a service platforms that we believe is the most complete portfolio for digitizing the patient's engagement from initial diagnosis or referral through to encounters in a hospital, a community health center, primary care, and at home. The portfolio covers online engagement, workflow automation, electronic medical records, integration to other in-house systems, secure sharing to external colleagues, and ongoing support for rehab and recovery. Our platforms work on any device, anywhere, and anytime. The initial touch point is our Hot Health Patient Portal, what the industry refers to as the digital front door, where patients or clients can book appointments online, submit pre-consultation forms, conduct video or teleconsults, make payments, and provide appropriate content, participate in discussion groups, forums, and more relationship management features. Our Master Care Provider platform has a comprehensive set of clinical features for doctors, nurses, and allied health professionals to completely digitize encounters between patients and their care team. Our Lifeguard Personal Health Record is designed to provide a longitudinal or cradle-to-grave record of a person's health, their medical conditions, their key measurements, allergies, and more across multiple providers that you encounter across your life journey. Essentially, Lifeguard provides a complete record of my health, and with integration through Apple Health to wearables and remote monitoring devices. Today, over 250 hospitals, community health centers, and primary care providers use our platforms as core for running their business. We also have a further 1,000+ healthcare providers that use our ReferralNet secure messaging platform for secure sharing of sensitive patient data with their industry colleagues, and the Hot Health Digital Front Door as add-ons to their core applications. With annual healthcare expenditure in Australia at well over $200 billion, we estimate the total accessible market, or TAM, to be more than $3 billion, and our immediate accessible market, or SOM, to be in the region of $35 million. The bulk of our revenue is in the form of monthly subscriptions or annual recurring revenue, with the balance being derived from professional implementation services such as data conversion, change management, platform configuration, and training. Our operations are managed by 40 Australian-based staff, covering software engineering, customer success, clinical and product specialists, implementation specialists, plus shared corporate services and sales and marketing. These are complemented by a number of specialist external contractors based in Australia and overseas. Healthcare is an industry that is characterized by escalating costs and a serious shortage of nurses, doctors, and allied health professionals across the world. The demand is ever increasing due to the growing incidence of lifestyle or non-communicable diseases as the global population trends towards a more sedentary lifestyle with an aging population. It is estimated that 1 in 2 persons have at least one non-communicable disease, and most have multiple non-communicable diseases such as mental health issues, hypertension, diabetes, and the like. Technology and innovation are essential for addressing these challenges. Our portfolio is built for supporting people living with chronic disease that require a team of different medical and allied health specialists working to a care plan that includes the client and the need for the client to modify their behavior, monitor vital measurements, and strive to maintain wellness or avoid a deterioration in an individual's health. There are several avenues to scale that the company is pursuing. This includes, of course, the organic business as usual or BAU growth in our traditional markets, value-add upsells to increase the share of wallet from our existing customers, partnerships with third-party best-of-breed vendors, and finally, through the recent reseller agreement with Fujitsu to drive growth in markets that were previously challenging, such as large deals, where Fujitsu can now help us compete, and access to 12 overseas markets through Fujitsu's in-country presence across Asia Pacific. Thank you for your interest and giving us your time listening to our story.
Good morning. My name's Peter Batten. I'm the Managing Director of Haranga Resources, giving a presentation on Emerging Gems. This is our October presentation. Read that if you wish. So I've only just joined the company in September of this year, and I was invited by Mike Davies, and I know John Davis, and I thought that meeting these people, it was a good team to work with. I've recently just returned from Senegal, where I met Jean Casson, our Chief Operating Officer, and he's very knowledgeable with 23 years of experience in Senegal. In Senegal, we have a uranium project and a gold project. We're talking about the uranium here. I have a background in uranium, having been in Bannerman Resources and White Canyon in Utah mining. And everybody's been looking for the second coming of uranium, and it looks like it might be here. There's a number of reasons for that. One of them is that the world now realises that there's a very low carbon footprint to nuclear, and that it is an answer to the renewable power industry with a safe baseline power generation. The reason that the market is feeling comfortable with the rise in uranium is the fact that the forward contracts haven't been covered, and they're not covered to 2030, which means there's a prolonged requirement for new production. A number of countries that had previously withdrawn from nuclear generation have come back and are expanding. Of these, notable is Japan, which committed to shutting all nuclear power down after Fukushima, but they're now restarting most of their reactors. There's a growth in the world reactor. There is a feeling that the predictions are that to 2040, there is a requirement between 200 million and 400 million pounds that is not being produced now. And the current projects going into production won't be able to meet that demand, meaning that new production, new sources of uranium are required. As I said, we're in Senegal. Senegal is in West Africa and is a stable country there, which has a stable mining act and regulations which are renewed in 2016, 2017 respectively. So in the southeast corner of Senegal, we have our Soraya project, which is over 1,600 square kilometres of land. And the place has been explored for uranium since the 60s by Kojima and up to 2010 by Areva. And in that time, they have gifted us with over 68,000 metres of drilling. Despite the fact that they had done all that drilling, there hadn't been a resource at Soraya until September, when we put the data together and we produced the inferred mineral resource estimate, which sits at 16 million pounds, 12.5 million tonnes at a good grade of 508 ppm. It's inferred. It can be up to metallurgical work and quite possibly a little bit more work on the database. That's the resource, and the wireframe model indicated that it wasn't fully populated, and that suggests that there can be extensions to the mineralisation. This will just require more drilling if it's there, and so the potential is to grow that 16.1 million pounds of uranium as we go forward, and that's something that we'll look forward to in the future. But at the present, what we have is Soraya is one of 7 anomalies that we have been gifted with from the historic work. The team in Senegal, led by Jean Casson, has undertaken comprehensive termite mound sampling. The termites get down below the laterite cover, which is masking any radiometric signal from the uranium, and we were able to get an indication of anomalism through termite mound sampling. To date, there are 7 identified, with Soraya being the only one that has been drilled extensively. We're now looking to drill the second of these, and the 3 anomalies that are in contention for this is Diobi to the north and Mendencolli and Sinella to the south. It's likely to be one of Diobi or Sinella completed for infill termite mound sampling. So the next step now is to try and get the orientation of that mineralisation, and we are just at this moment organising auger drilling on Diobi and Sinella, getting permits from the Forestry Department and the ANSR so that we are allowed to shift our samples. But apart from that, there's still portions of the tenement that haven't been looked at properly, and to that extent, we have other radiometric anomalies further south and southeast of where we are now. The 7 anomalies we do have form a 25-kilometre long corridor of mineralisation. So this is the situation that we have in Senegal. Senegal is a stable geopolitical location. We have an initial resource which is robust. It's the first of 7 anomalies that we have, and we're looking to drill 2 remaining 6. We hope that the auger work will give us a choice of 2 by late November, and that we will enter into RC drilling in December. As previously stated, the global uranium demand is increasing. The spot price went up by 30% in 2022, and it's up over 40% so far this year. And we think that that's sustainable for a number of years, given the reasons earlier about the contracts being out and the increase in the number of reactors and the acceptance by the world of nuclear power as a clean, carbon-free electricity that gives baseload component continuously 24/7, 365. Another reason is the vulnerability of energy supply chain in the West, as seen with recent issues, both in the east of Europe and in the Middle East. We think that we're quite well placed for the future. We know that there's uranium there. We can see that our maiden MRE will be expanded on, and we hope considerably. And we have the team in place to do that. We have our own camp, 40-man camp out at Soraya. We have a relationship with the drilling companies. We have been drilling there before, so it's been done, and it's just a matter of getting the work out of the way, and we think that we'll get the rewards for that. In addition to our uranium, we also have a gold project in Senegal, and that's the Iwal South project, and we've highlighted a number of anomalous regions within that, and it's part of the Burundi, which is a very lucrative geology to be in. That's the Harenga story. Thank you.
Thanks very much to the organisers of the Capital Network. I'm delighted to be presenting today, and thank you very much to everybody for taking the time to listen in. I'm looking forward to taking you through the story at Arabella Therapeutics. For those of you that aren't familiar with the company, we're a biotechnology company listed on the Australian Stock Exchange under the ticker ALA. I will be making forward-looking statements, so please do note our disclaimer. And let me just start with the highlights of the company. So we're working on an invariant natural killer T, and it's iNKT cell for short. And I'll explain what that means in a moment. But essentially, it's a way of enabling us to target both blood cancers, and also we are moving into the solid tumor space. So our lead program is called ELA-101, and this is a therapeutic we're developing to tackle cancers that have something called CD19 on their surface, and we're expecting to take that program into clinic in 2024. We believe our platform addresses key unmet or needs that have currently hampered the cell therapy sector. We've built an exceptional team with a lot of experience across drug development and especially across cell therapies. The company has really evolved and been built through strategic licensing or acquisition of what we consider to be some of the best intellectual property worldwide. And as one of a handful of companies globally working on an iNKT cell platform, we do see that we're well positioned for growth with a unique value proposition. So I won't go through all of the team members in detail, but just to say at both management level and board level, we have an exceptional team with experience that spans right the way from very early stage academic research through drug development and then through to commercial transactions for biotechnology assets, both in the therapeutic space and the medical device space, and particularly, again, as I mentioned, in cell therapies, which is very important for this type of therapeutic. Now, in terms of cell therapy, for those of you that don't know, it's often referred to more affectionately as CAR-T. It has enabled us to start using the word cure and cancer in the same sentence for blood cancers because of the promising results. And not surprisingly, the first two products approved in 2017 have already started to generate strong sales as a result of that. And the market is expected to be quite large at more than 60 billion by 2030. Unfortunately for these therapies, not all patients have prolonged durable outcomes. And so we do see that in some cases, 40 to 60% of patients do relapse from post-taking the therapy. Now, this is just a great example of the first pediatric patient that took a cell therapy like this. Now it's 11 years that she's cancer-free post-taking that therapy. So again, just a quick snapshot and highlight of why these therapeutics are gaining so much attention and this class of therapeutic is gaining so much attention. So how do they actually work? So we've got what we call CAR T cells, and the T stands for it's a type of immune cell that's in our body, always floating around, looking to remove things that don't belong, whether it's a microbial infection or a viral infection, or in some cases, cancer cells. So we actually take blood from the patient that's got the cancer, collect the T cells, they go into a lab where they get genetically reprogrammed. And what they end up with is something on their surface called a CAR, which is where we get the CAR in CAR T. And thinking about that like a guided missile, it's now trained to go and recognize something found exclusively on the surface of those cancer cells. And then they get grown up into the millions before being infused back into that patient. And so here, the little green bumps represent something on the surface of the cancer cell, which now the supercharged T cells will find, and then they'll cause destruction of the cancer cells once they do that. So really important here message is that we start from the patient and we finish with the patient. So while we've seen wonderful success with CAR-T, unfortunately, the current workflow it poses significant challenges because we have to start with the patient and finish with the patient. So what that means is it drives up the manufacturing challenges and as a result, the costs. So to take the therapeutic, it's in the order of about $500,000 US per dose. Also because the patient's T cells may have some cancer or chemotherapy or other types of therapeutic modalities, we believe that also can reduce the fitness or the functionality of that starting material. So we may have a less efficacious product. And also not all treatment centers can actually make the therapy. So there will be a range of patients that could be eligible to take this type of treatment, but they won't actually get access to it. So we're working on what we call a CAR-iNKT cell platform. And the real key value proposition here is that we can actually take the immune cells from a very healthy donor, and then we can actually generate that therapeutic and give it to many patients, which we think will alleviate a lot of the challenges around supply chain. Now, in addition, a CAR T therapy, because we have to make it in real time for everybody, it takes about 4 to 6 weeks. And unfortunately, it does happen that patients can actually die while waiting for that treatment. So that, particularly in cases where the disease is quite aggressive, and because you're actually making it every time, there's always the risk of a manufacturing run failure. So for our iNKT cell platform, the intention is that the material is stored appropriately at very, very cold conditions, like in liquid nitrogen or -80 degrees, and that would be able to be removed, thawed out, and given to that patient. So if they're eligible, they should be taking that therapeutic a lot faster. So very quickly, highlighting what invariant natural killer T cells are, I've briefly introduced T cells as the most well-known for CAR T. There's also another class of cells called NK cells, which are also quite well-known. And we focus on iNKT cells. Now, why we're so interested in them is they actually bridge the two halves of the human immune system, the innate or the fast-acting immune system, as well as the adaptive, which is the more prolonged or durable part of our immune system. They can actually kill like a T cell or an NK cell. And in certain cancer types that have something called CD1D on their outside, they actually naturally already target and kill these cancers. Now, really importantly for us, unlike T cells, they don't cause what we call graft versus host disease, and that's what enables us to be able to give them from a healthy donor to many patients. In addition to that, they actually have a number of other anti-cancer properties, such as shaping what we call the tumor microenvironment, and they also have the ability to stimulate other immune cells to join in the fight against the cancer cells. So in terms of the commercial landscape, when we look at the T cell and NK cell spaces, they are quite crowded. There's a lot of companies and a lot of clinical trials ongoing. But when we look at the iNKT cell space, it's really just a handful of companies operating in this particular sector. So it's great that we've managed to carve out a niche area in a very high value area for oncology treatment and cell therapy. Now, I won't go through all these transactions in detail, but certainly important to note here that despite the challenges that have faced the biotech sector over the last 24 months, we still have seen quite a number of licenses, acquisitions, or collaborations. And also for all of these phase 1 technology, which was at phase 2 clinical trial stage or preclinical, we still see some quite sizable deal terms, some in the order of hundreds to $200 million upfront payments for entering into those particular arrangements. Now, in terms of Arovella, our financial position, we're currently capped at around 81 million. As at the end of September, we had $5.32 million cash in the bank, and that does not include the $2 million that we're expecting to receive before the end of this year as part of our R&D tax rebate. We're delighted that our largest shareholder is Merchant Group. They've been very supportive and continue to be supportive of the company and our activities. And we also have a number of high net worths and also smaller institutions that have been quite supportive of what the company is trying to achieve. So over the course of 2023, we've seen a pretty solid performance in terms of share price appreciation. But of course, we're always looking to welcome more investors to the register that understand both the risks, but the potential rewards that can come with an investment into the biotechnology sector. So in terms of our pipeline, we have now a few shots on goal. Our main program, ALA-101, which we're looking to take into patients with non-Hodgkin's lymphoma or CD19 producing leukemias or lymphomas. We've combined that with another company's oncolytic virus called Imugene, and delighted to have that as it gives us a shot on goal by using both platforms together to tackle a range of solid tumors. And we're also continuing to acquire and license new technologies from groups such as the Spark Group, which we announced a few weeks back, and also MD Anderson, which we announced quite some time ago for our DKK1 program, but again, giving us multiple shots on goal for targeting solid tumors. And we've also got a cytokine technology, which we will strengthen the entire platform against solid tumors. And we've got that option from the University of North Carolina. So in terms of our milestones and news flow for the next, say, 12 to 18 months, our key goal is to take ALA-101, our lead program, into clinical trials in 2024. So to do that, we're working through the manufacturing stages, and we expect to be providing some updates on that work before the end of the year, which is quite exciting. And then the next step is to take that to start making the material for clinical trials in the first half next year, and have the material being prepared to submit to regulators like the TGA or the FDA. In terms of our other early stage proof of concept programs, we expect to get data for the collaboration with Imugene before the end of the year. And we're continuing to look at additional technologies such as the cytokine technology, which is currently under option to license into the company. And so over the course of the first half next year, we'll continue to generate proof of concept data to look for activity of the iNKT cell platform in a range of solid tumor models. So in summary, we have a really exciting CAR iNKT cell platform, which is quite unique worldwide. We believe this will have a very big impact in alleviating the challenges that currently plague the cell therapy sector from a manufacturing perspective. Now, we know that the iNKT cells have multiple anti-cancer properties, which we're excited to test in both blood cancers and solid tumors. Delighted that we're looking to take our lead product, ELA-101, into clinic in 2024. And as I've just alluded to, we continue to license in new technologies that help us to expand our pipeline in a very focused manner for solid tumors or tumors that we're interested in. And for all these reasons, we do see that Arovella is sitting in a very good position and well poised for growth. And with that, I'd just like to say thank you again for your attention, and to the Capital Network for putting on the event. Thank you.
Good morning, everyone. I'm John McCutcheon, the President and CEO of EBR Systems, and I'm happy to be able to share the EBR story with all of you here today. The EBR focuses on pacemakers, the pacemaker market, and most people are aware of pacemakers. You probably have some family member or relative who has a pacemaker. The first pacemaker was implanted in 1958, so they've been around for 65 years now. And they've evolved over time, and they've all consisted of a box or a battery that has leads or wires that go into the heart. And the advancements since 1958 have been around the size of the implant. They've gotten smaller and smaller. They've gotten more intelligent as electronics have matured. The indications have expanded from slow heart rate to patients that are at risk of sudden cardiac death, and now on to heart failure. But all of them, until recently, have relied on these leads that go into the heart, and those have always been a problem. So it's great when it works, but sometimes those leads can fail. They can fracture, they can migrate, they can get infected. Sometimes the leads are difficult to place. And so they've always been known to be suboptimal, and there have been a lot of work going into perfecting the leads. But up until recently, it hasn't been possible to eliminate those leads altogether. And that's where EBR systems come in. We have the first leadless technology that can be placed in the left ventricle to treat patients with heart failure. Now, the leadless pacemaker market is just starting to take off. It's dominated at the moment by Medtronic and Abbott. They both have leadless pacemakers that go in the right ventricle to treat patients with slow or regular heartbeats. Boston Scientific, as you can see in the middle of those three, has one in development, but it's not currently on the market. The only company that has anything that is in development or is on the horizon for treating patients that need left ventricle leadless pacing is EBR Systems. So the other leadless pacemakers are rather large compared at least to the EBR Systems pacemaker that goes in the left ventricle. And the sizes you see here are somewhat to scale as best as we could. The EBR system, wide CRT system, is about 0.05 cc's in volume. That's about the size of a grain of rice. The leadless pacemakers that you see on the right that go into the right ventricle, those are all about the size of a small battery, about 1 cc in volume. So much too big to be put in the left ventricle. The problem there would be they could generate clots, thrombus, and interfere with the structures of the left ventricle. So only EBR can treat the left ventricle. That means we can treat patients with the heart failure where the left ventricle gets bigger and bigger, gets distended. And the goal is to reverse that and make that left ventricle smaller. And the other great thing is that these systems are complementary. We can work in conjunction with these leadless pacemakers that go on the right to deliver what's called biventricular pacing, where they have, say, a Medtronic Micra leadless pacemaker on the right side and we can pair with that with the WISE system on the left to have completely leadless biventricular pacing. And that's a very, very new thing and a breakthrough in this clinical arena. Now, we recently presented our clinical data of our pivotal trial, and this was at the HRS, Heart Rhythm Society meeting in May of this last year. And we met our primary endpoints, which means we're now on path to getting FDA approval. And we didn't just meet them, we really exceeded them in a significant way. So as I mentioned before, the goal of treating patients with heart failure is to reverse the expansion of their left ventricle. We want to shrink the left ventricle. And the primary efficacy endpoint was a reduction in left ventricular volume. And that's an acronym called LVESV. We reduced that by 16.4%. And it's very meaningful because a clinically relevant reduction is on the order of about 9%. It's been shown that if you can reduce that heart volume in patients with heart failure by 9% or more, that they have greater survival and reduction in heart failure symptoms and problems. And so very, very significant at a statistical significance of 0.003. Also, our freedom from complications at a p-value of 0.001, highly significant and clinically meaningful. And so what's important about these data, again, it's the foundation for our impending PMA submission and ultimately our FDA approval that will lead to our commercialization. For commercialization strategy, once we have FDA approval, it's a very focused initial targeted strategy. We'll launch in the US because it's the largest medical device market, has the highest ASPs, and it's also a very focused market. So the top 250 centers roughly do about 50% of all the volume. And so we don't need to target every center in the US in order to drive significant revenue. And we'll do a phased rollout. We'll start with a small sales force, do an initial launch, and then expand further and further from there as we demonstrate traction and clinical success. And we'll initially target our clinical sites that were from the pivotal study. So we're going after or targeting surgeons and physicians that already have experience with the device, understand how to use it, how to roll it out, and really believe in the clinical utility of this. It's a very high clinical need, unmet clinical need. So we're not competing head to head with any existing technologies. Our initial indications are for patients that have failed conventional CRT or conventional lead-based systems. Therefore, there's no direct competition. These are patients that have very little, if no other options, and therefore there's not a high clinical hurdle for us to address these patients. There's no hospital adoption barriers. There's no capital equipment, no long-term contracts that need to be signed. And we're going to have a very, very high average selling price in the US with our CMS coverage that we get with this new technology add-on payment that we benefit from because of the breakthrough device designation status that was conferred upon us by the FDA. We already have our base sales force in place. We have a skeleton crew at the moment, but we'll expand those as we get closer and closer to commercialization. And these are folks that help drive cases during the pivotal trial, and they're skilled in both sales, but also in the clinical proctoring of our system, and will facilitate that rollout. So upcoming milestones, we had a big 2023. We've already hit a number of milestones. Probably the most important was what I mentioned in terms of the headline data and the meeting our primary endpoints at the Heart Rhythm Society meeting. We've also released some sub-analysis that supports the primary analysis, showing that EBR system, WISE system, is safe and effective for these patients and highly beneficial. In 2024, we'll submit the final PMA module. I didn't mention this earlier, but we're doing a modular format, meaning that we submit the PMA in pieces or modules so that some of the questions can be addressed early on, and that way the final module goes in and there's a lot more likelihood that it'll go through in an expeditious manner and not be delayed. And ultimately, that'll get us to FDA approval, where we will be doing our commercial launch in 2025. Beyond that, we'll go into other non-US markets. In particular, we'll be targeting Australia and many countries in Western Europe. We'll also be looking to expand our indications and expand the technology. We continue to invest in R&D. One example is a rechargeable battery. Our current battery is replaced every 4 years or so, and it's a minor surgical intervention, but still it would be much better for the patients if the battery lasted the life of the patient, and a rechargeable battery can do so, and it's also much smaller. And our initial market research shows that this would be very well received by patients and clinicians. So one of the R&D projects that we have underway. So with that, I'll wrap up the presentation, and I want to thank everybody for your attention. And it's been a pleasure speaking to you.
Hi, I'm Chris Noon, CEO of Carly Holdings Limited. Carly Holdings is a company that operates in the car subscription market in Australia and New Zealand. We've been operating in the market for a number of years, and we are active in the car subscription and electric vehicle markets. We're proud to call some of the largest players in the automotive market in New Zealand and Australia as our large shareholders, including SG Fleet and also Turners Automotive. We are the only ASX-listed company focusing on the car subscription and EV opportunity in Australia. We launched Carly Car Subscription in March 2019. It's the first flexible car subscription service in Australia. Car subscription is the use of a car without the burden of long-term ownership or debt. A monthly recurring payment covers all expenses, just add fuel or electricity. And car subscription is a flexible alternative to finance or outright purchase of a vehicle. 38% of Australians are interested in car subscription, and that interest increases as the age decreases. So 69% of Gen Z and 50% of millennials are interested in car subscription. The car subscription market is predicted to be a $100 billion opportunity by 2032. So Carly operates in key segments of the car subscription market in consumer, business, electric vehicles, and we're also involved in software licensing as well. We have two ways of building our fleet of vehicles. First of all, we have a direct fleet that we either own, finance, or lease. We also have a partnership fleet, which is also our asset-light model. And this is where manufacturers, dealers, and fleet management companies provide cars to us for us to monetize on their behalf while they retain the ownership of the vehicles. Carly is growing very strongly. In our latest quarterly results, we announced subscription revenue growth of 106%, while our fleet grew by 78%. So what is a car subscription? It's a simple monthly fee to subscribe to a vehicle. It includes registration, insurance, maintenance, and roadside assistance. You have exclusive use of the car. The minimum term is 30 days, and there are 30 days notice to terminate the subscription. You also have the ability to switch the car to meet changing needs. Importantly, car subscription is not long-term financial commitment or debt. The average period that our subscribers take our vehicle is 5.2 months. It positions us very nicely in between rental, which is typically 7 to 14 days, and finance and purchase of vehicles, which is typically 2 years or more. So in the 5.2 months sector, we have a very large niche of both individual and business customers that we can meet their needs. So looking at our September quarter results, 78% increase in our fleet size, which also produced a 106% increase in our subscription revenue. Our cash receipts grew 41%, and while growing our fleet, we also kept our costs under control, reducing our cash used. And you can see in this graph, which displays both our asset light and our asset heavy fleet of vehicles and the increases in subscription revenue that has driven. So we've had a strategy of increasing the proportion of asset-heavy vehicles within our fleet, and that has had an immediate impact on our subscription revenue growing. Currently, over 70% of the vehicles are owned or financed by CALI, with around 30% coming through on the asset light model. So we aim to be the #1 car subscription company in Australia. We're already established in the consumer market. We're also, we have a very low cost of acquisition and a strong online presence, and a number of referral partnerships which can deliver us also lower cost per acquisition in the future. We want to be #1 in the corporate and government market. We're proud to call SG Fleet as our second largest shareholder, and SG Fleet refer their business, government and not-for-profit customers to us when they need vehicles for 1 to 12 months. We also want to be #1 in the electric vehicle subscription market, and we're proud to call Hyundai one of our strategic partners in that market. And we also work to power the subscription services offered by manufacturers and dealers as well. So we operate in a direct manner, but also with larger partners within the industry. So what have we been doing lately? We've now grown our fleet to over 350 vehicles. We have just launched a radio advertising campaign as we seek to take car subscription to the mass market. We've also signed up for employee benefits programs, potentially positioning our offers in front of up to 990,000 employees. We've also established our own corporate sales team to supplement the referral business that comes through from SG Fleet as well. We've just announced a deal with ChargeFox, the largest charging network in Australia, where we're packaging EV charging credits with the electric vehicles that we're subscribing to customers. We've also signed agreements for our new CALI Now product. CALI Now is an app that allows an automotive dealer to sign up subscriptions for their vehicles in the dealership showroom. So it allows them to take an immediate opportunity to subscribe a car to a person at times when purchasing that car or financing car may not be the right solution. So why invest in CALI Holdings? We have a proven business model. There is no blue sky in our business. We have all of the proof points of all elements of our revenue generation, of our fleet growth, of our consumer behaviour. We've tested and proven that we can run a very efficient and scalable business. We're securing the pathway to profitability. We've identified opportunities in the business, consumer and EV markets, and also working with large industry partners. And we've demonstrated success in each of those areas. And we're also scaling direct with our own fleet. We have just in March of this year signed up a $10 million finance facility, taking our total financing facilities to $13.2 million. And we're also growing our fleet with vehicles supplied by our corporate partners as well. Thank you very much for your interest in CALI Holdings.
Hello, my name is Michael Thurn. I'm the CEO of Pharmos. Pharmos is a clinical stage biotechnology company focused on repurposing monopentol for human and animal diseases. Monopentol is an approved veterinary drug commonly used to treat nematode infestations in sheep. Pharmos has 2 clinical development programs, a human health rare disease program for motor neurone disease and an animal health or veterinary program for treatment of B-cell lymphoma in dogs. Both of these programs look to exploit the ability of monopentol to inhibit the mTOR pathway, a well-known and key pathway controlling cell growth and proliferation. And we look to leverage the large safety database already established with regulatory agencies for monopentol in our development programs. To protect our product portfolio, we have a family or a number of families of granted patents in key jurisdictions worldwide. We have assembled a management and board of directors with experience in nurturing and adding value to ASX-listed companies. And this company is overall supported by a broad and loyal investor base that we hope to grow over the next 4 to 6 months as clinical programs move towards key development milestones. Pharmos is advancing multiple synergistic product opportunities in human and animal health by repurposing monopentol. Recently, we announced that the final patient had completed dosing in our phase 1 motor neurone disease study. Data from this phase 1 study will be used to support an orphan drug designation application and to open an investigational new drug application in 2024. These are important milestones for Pharmos as we gear up towards starting our phase 2 study in the first half of next year. Before we get to that point, though, there's still aspects of the phase 1 study that we need to complete. Patients have to have one last follow-up visit, and then there's also a process of closing out the study through data collation, and cleaning process begins in order for those top-line results to be released during the first quarter of 2024. We also announced recently the completion of our phase 2 canine oncology study in B-cell lymphoma. And in that study, we were able to show monopental provided an overall clinical benefit and a mean time to progression of 28 days. This compares very favorably to the most recent drug approved for B-cell and T-cell lymphoma in dogs, Livadia, a fantastic result. We now plan to open an investigational new drug, animal new drug application with the FDA Centre for Veterinary Medicine in the near term, and to proceed with pivotal studies in 2024 to support product registration. Pharmos is well positioned to execute on these multiple near-term catalysts. Pharmos is positioning its development programs for a high-valued licensing or acquisition deal, focusing just on the rare disease market, a market our clinical program for motor neurone disease operates in. There's been enormous interest in rare diseases over the last 8 years, largely because of the generous set of regulatory incentives like 7 years market exclusivity, orphan drug designation, and accelerated approval under the Orphan Drug Act. We are now seeing close to 100 deals annually in the rare disease space, so it's not surprising that in 2032, the market for rare diseases is expected to reach greater than $435 billion. This is supported by the increase in rare disease drug approvals over the last 5 years, with 50% of drugs approved by the FDA are for rare diseases. It is also supported by the large acquisition deals that have been occurring in the rare disease space lately. Chinook Therapeutics was purchased by Novartis in June this year for $3.2 billion. And then the largest biopharma deal in 2022 was Amgen's acquisition of Horizon Therapeutics' rare disease pipeline for $27.8 billion. We expect interest in Pharmos' rare disease program for motor neurone disease will escalate following successfully obtaining an orphan drug designation, and when our top-line results for our soon-to-be completed phase 1 study are available.
My name's Sam Swanell. I'm the Managing Director and Group CEO of PointsBet. Thanks very much for everyone that's listening to this presentation today. PointsBet is a Australian-based wagering company. We have operations in both Australia and Canada. We're at an interesting time in the history of the company. We have previously also been operating in the US market, but we're in the process of selling that US business, and I'll talk to that a little bit later. So PointsBet, we are a growth company. You can see the profile there of our combined Australian and Canadian businesses. We were founded back in about 2018. The initial business was just our Australian operations, and our Canadian operations joined in and started contributing revenue to this table in early 2022. So financial year 2023 was the first full year of our Canadian operations. You can see the trajectory that we've been on. We've provided some guidance to the market around what we expect to see in FY24, and that is revenue growth of circa 10 to 20%. Importantly, we also have provided guidance to the market that when we complete the sale of our US business, which is scheduled for around March next year, we expect the business to come out run rating at EBITDA break even, moving into EBITDA positivity in FY25. So, we see ourselves as a really interesting company that is generating strong revenue growth within a profitable landscape. So that's the aim for the company over the next 6 months, is just to complete the sale of our US business, deliver on the revenue growth of Australia and Canada, and move the group into a positive EBITDA environment for the first time in its history. We've just reported our quarterly 4C numbers, which is a cash flow required statement. But these are the revenue numbers that we've reported to the market for the September quarter. this is a combined Australian-Canadian view. So the really important line is the bottom line. So we've grown total net win. Total net win is basically revenue. In Australia, you need to withdraw the GST from that number. But we've grown that number very strongly, 18% on the PCP. So compared to September 2022, we've had a really good quarter and grown net win by 18%. You can see there that we split our net win or our revenue into two parts, sports betting and iGaming. And this is a really important distinction. In Australia, we have a very different market to what exists in Canada. You know, Australia is a more mature market, very big on racing betting and sports betting. The Canadian market is in its infancy. It's going to provide the opportunity for really strong growth. But over in North America, they do have iGaming or online casino. So people are able to play, you know, blackjack and slots and roulette, etc., you know, on their phones. We also have what we call live betting. And so in Australia, once a event has started, an AFL game or an NRL game or an NBA game, you cannot bet on your mobile phone online once the game has started. In most other parts in the world, you can, and it's a very popular way of betting. You can imagine that a lot of people like to have a bet once the game has started and they're seeing what's going on in that game. And a lot of what we have invested in as a company is around that live betting capability and around that online casino capability, which is very important in markets outside of Australia. So Australia is our base. It's the largest part of our business as it stands at the moment, but our Canadian business is very important as we want to deliver growth as a company. So the highlights from the first quarter, Australia was up 11%, Canada was up 212%, obviously off a more early stage base. I said that FY23 was the first full year of operations in Canada. FY24 is the second year. What we invest in is our technology and our product. And that product is the product in the hands of the consumer who's having a bet, but it's also on the back end in the ability for us to execute our business plan with surgical precision. And one of the areas that we've made great improvement in the last 12 months is our ability to distribute generosity or promotions to our clients as efficiently as possible. So you'll see on the Australian side there, it talks about the fact that promotions as a percentage of our gross win have reduced over time. And that basically just means that we're getting more efficient in the way that we hand out promotions while still delivering the same benefit from those promotions or generosity. You know, really interesting, this is a trend in both of our markets. We've found great efficiency from a marketing perspective. Again, how? Well, we've got better. You know, we've found more efficient marketing channels, more efficient marketing execution. So our Australian result, whereby we delivered an 11% growth for the September quarter on the PCP, was delivered while delivering a 41% decrease in saving. So a really real strong progress there in terms of the efficiency of the way we generate our revenue. Similarly, in Canada, we found some savings in Canada as well. It was about a 7% decrease in marketing, and still delivering strong growth in that earlier stage market. You can see there, we talk about in-play betting representing 68% of our sports handle. That basically means in-play betting is what I was talking about when I was talking about live betting before, the matches in play. 68% of all of our bets over in Canada happen once the match has already started. And again, this is our strength of our business, which I'll talk to shortly. And as I mentioned at the outset, we are in the process of actually selling our US business. We sold that business to a group called Fanatics Betting and Gaming. There's a process whereby we need to get approval from regulators in the US to complete that sale, and we expect that sale will happen in the March quarter next year. Effectively, what we've done is the proceeds from selling that US business and some excess cash on the balance sheet, now that we're no longer investing in that US opportunity, is being returned to shareholders. So we've had $1 per share that we returned to shareholders in September, and we have another distribution to come once we close the transaction in around March or April, and we've discussed that will be announced that will be 39 to 44 cents per share. So there is some noise in our share price at the moment. You know, if our share price, as an example, is 75 to 80 cents, included in that is an expected distribution of between 39 cents and 44 cents, which will go out in around March or April next year. So as our business has become more predictable, certainly in Australia, where we've been operating for a number of years now, and we have been EBITDA positive in Australia pretty much, I think, for the last four years. The group, once included the investment we're making in Canada, is currently loss-making for FY24. But as mentioned earlier, and as set out in this slide, we anticipate moving into group EBITDA positivity in FY25. So we've provided some guidance to the market on what that will look like. So the starting point is our net win rising by 10 to 20%. We've given some guidance around gross profit margins being stable at around 50%. We've talked about finding efficiencies in our marketing, which I spoke to earlier, of say 15 to 20%. We've given some guidance around our OPEX, and that provides a pathway to how we plan to deliver EBITDA positivity in FY25, beginning with around April next year, the April, May, June quarter. We think that will come out of the sale of the US business, run rating about break even, and then moving into positivity. Spoken about live betting or in-play betting, and this is a key part of our right to win, not just in Canada. It's also important for Australia, but live betting in Australia is done via the telephone, calling up and making a call. So it does diminish the appeal of the product compared to the Canadian market and global markets more broadly. So as we entered the North American market, and before we sold our US business, we were live in 14 states of America plus Canada. And the big sports in America, as everyone would probably understand, are NFL, NBA, basketball, college basketball, baseball, soccer, ice hockey. And we have this part of our business called Odds Factory. And I think it's probably not hard to understand that being a bookmaker pre-match is a lot simpler than being a bookmaker once a game has started. And the example I would give is, if we're betting on a basketball game, the NBA season's about to kick off. If we're betting on a basketball game all the way through to the tip-off, not much changes unless a player gets injured or something else dramatic happens. You put up the odds adjust. You've got time to make decisions. Punters have got time to assess the odds on all the different bet types, and we have more bet types on NBA and NFL than most bookmakers in the world. That's one thing. But once a match goes live and you've got players scoring, you've got players being fouled, you've got how quickly is the game developing, then being a bookmaker and setting the odds for all of the things that we bet on, every player, all the player props, results, total points, outcomes of games. There's hundreds of bet types, and when you're offering those bet types live, I think everyone can understand that the complexity around that becomes far greater. And the way we do that is basically we consume data feeds on all of these sports of what's going on in these live matches. So we're consuming data feeds constantly from around the world. We're digesting those data feeds, and by that we're running our models about this is what the data is telling us about what's happening in the match, and we run our models, billions of simulations, which basically says what happens next. And we have markets, for example, in baseball, we have markets that says, what happens next in terms of the batter up at the base. What are they going to do? Will they score a home run? Will there be a strike? Will they make it to first base? In the NFL, we have what happens next markets. In the NBA, we have not what happens next markets. So we're basically predicting what's going to happen in the game, and we're putting odds up on our website for people to bet on. That's the whole point. We put up the odds, and they assess whether those odds look attractive, and they back their opinion. So the complexity around offering live betting or in-play betting on sports around the world is where the technology, the models, the trading expertise of bookmakers or sports books such as PointsBet really come to the fore. And one of the things that we're really proud of, although ultimately we ended up selling our US business, that was more, I suppose, a decision around brand. The PointsBet brand wasn't a known brand in the US market, up against some massive brands with some really big balance sheet and some spending. Our product in the hands of the consumer for the last 5 or 6 quarters has been ranked top 3 in the US market from a field of about 60 online bookmakers that operate in the US market. And so our product, where we've focused our efforts and our right to win, is really rated as world-class. And that's why we continue to grow market share in Australia and Ontario. And in Ontario, Canada in particular, we're really excited about the focus that we can bring from our product and technology capability to the early stage Canadian market. There's factors in the Canadian market that make it really attractive from a margins perspective. It has a very acceptable tax rate. It has the iGaming product that I spoke about, or online casino product, as I spoke about further. And we're really proving that we can compete in that market, which is fantastic. So we are a technology-led company. We believe that we have a capability in the way that we've built our platform that allows us to innovate very efficiently and to out-innovate the marketplace, to do more with less. And that's what is driving our growth in the slightly more mature Australian market and the really early stage Canadian market. So we believe we've got great momentum this year. We're already a tier 1 product in both markets. In Australia, we're on our way to, we're about a 5% market share in Australia, and we're growing from that, and we believe we can secure a top 4 position. The party above us in Australia is probably about a 6% market share player, or 5 or 5.5, and we think we're on our way to surpassing them. We're very experienced in highly regulated markets, and that shouldn't be underestimated in terms of the value that is placed on companies like PointsBet that have operated in North America, Australia, highly regulated markets. We are not a grey market operator. Everywhere we go, we're fully compliant, and that takes effort and cost, and we're very proud of our record there, and it does create value inside the company. Our Canadian business is obviously early stage. That's where the hyper growth is going to come from. That market will continue to expand, and we'll continue to grow with that market. And we do think of our technology as value in its own right. Our Australian business has value, our Canadian business has value, and what we've built from a technology perspective clearly has value. We've invested a lot of money in our technology as we pursued our American, Canadian, and Australian markets. We've got top line growth. We're reducing our costs. We're well on the way to that profitability that I've spoken about. And really importantly, in the current environment, we've got ample capital. As at the end of September, we have $83 million Australian in the bank, 83.5, I think it is. We do have some cash flow to occur, whereby the proceeds of the remaining proceeds of the sale of our US business will come in. We will pay out that 39 to 44 cents per share to shareholders. But in the current environment, we will be well capitalized to pursue the growth aspirations of the company. Thank you.
So Cleantech is an ASX listed company, and we're under the symbol CNQ. The normal disclaimers. And so let's talk a little bit about Cleantech. So Cleantech is a specialised technology company, and we're really solving some of the world's most pressing resources challenges, especially in the area of the water and mining sectors. We've got a full suite of technology tools which provide best practice in the filtration and separation of water and minerals. And we're really focused on 3 major areas. Number 1 is the lithium demand. Number 2 is the mining rehabilitation area. And 3rd is our freshwater scarcity problems. And each of these problems is a global problem. So these problems also are really being accelerated by the carbon reduction goals that have been placed on most companies, and they're all working very hard to achieve the goals. The first one here is lithium, and lithium is obviously needed to support the growing demand in electric vehicles, and it's a key component of the lithium-ion batteries that are used in these ESV vehicles. The lithium demand is expected to grow more than 40-fold by 2040 if the Paris Agreement for carbon reduction goals are met. And there is going to be a significant gap between the supply and demand curves for lithium. And we have a very significant role to play in this sector. The second sector is the mine rehabilitation area, where it's really important for the miners to save both the water that they're using within their mining endeavours, and also to get other valuable products from the tailings, which is the mine waste, which is currently going just to the storage facilities, and in the end ends up being an environmental and safety problem for the miners. This market is expected to grow quite quickly as the mining supports our current climate goals. And the area of freshwater scarcity is a real issue. And we see that every day on our news, that our water supplies are becoming more contaminated as population growth and urbanisation and climate is having an impact on our very, very, shall we say, limited reserves of fresh water. So purification in this area is an area where clean tech technologies can play a big role in ameliorating these problems. So clean tech now has structured itself to capitalise on these markets, and we're looking to change from being a project and product providing type supply to the markets to be more focusing on equity ownership via business partnerships, which will enable both revenue and capital gains for our shareholders. So our first partnership has been via our Go to Lithium spin-out, which enables us entry to the strategic North American lithium market. And Go to Lithium will utilise the licence to our direct lithium extraction technology, which extracts lithium from brines in the North American area. And that will provide a source of lithium in this particular area. And North American sourced lithium is critical to the future of the US EV car markets. And US is providing a lot of incentives for companies to make this happen. So Go to Lithium has now done its first deal, a technology for equity deal, whereby Go to Lithium will earn up to 26% in the TSX-listed entity Lithium Bank. And as we progress this partnership with Lithium Bank through piloting and engineering stages, we expect to see Lithium Bank's value increase substantially. And our equity stake within Lithium Bank will follow that as it moves through various milestones from its preliminary economic assessment all the way through a bankable feasibility study. The deal also provides the measure of the worth of the technology in the lithium space. And so we will be pursuing these deals with other asset owners in the lithium market space going forward. We also look to do innovative partnerships in the mine tailings rehabilitation area. Our recent acquisition of the ATA technology, which is a technology which provides accelerated dewatering technology, is central to this market. Mining companies have a really big problem to solve around tailings storage, and we expect that ATA technologies will be game-changing in this area. The ATA technology will allow the companies to look at opening up the possibility for metal recovery from tailings, to get processed water recycling done in a much more efficient way than it's currently done, and also will allow them to move from current wet storage techniques through to dry stacking techniques, which then takes away a lot of the environmental and life-threatening harm that can be caused through failures of these tailing storage dams. And finally, we come to our water area, which has really been the central platform on which Cleantech Water has existed today. And we'll continue working in this area, generating revenues. To date, we have around about $10 million in contracts in calendar year 23, and we expect our growth in this area to continue. Just a little bit of a recap on 2023. As you can see, we generated $13.6 million in total revenue, which was up by 9% on the previous year. And we achieved this revenue through the delivery of a number of quite important demonstration projects in the water treatment area. All the way through from the one that you see here, which is Townsville Recycle Treatment, which is still in progress, and we expect to finalise that contract around the February mark of 2024. This is taking effluent water and recycling it for beneficial reuse, all the way through to the project we've done in the Middle East with NESA, where we have taken groundwater and achieved excellent results in terms of recovery of groundwater for use in completion waters, and also our ion exchange technologies, both in Kumala and also in Larumba. We just recently won a Northern Territory Award for the Larumba water treatment plant, where we've done, I think, a fantastic job in improving the health of the Aboriginal communities by providing good drinkable fresh water. So those areas have been really, I think, a success for cleantech in 2023, and we're looking forward to pushing that further into 2024. I think we've got plenty of news flow to look forward to from cleantech in 2024. It will include our progress with the Go to Lithium joint venture, where our pilot plant will be delivered to Canada, and we expect to have that up and operating in the Q1 in calendar year 24, and also for future agreements with other asset owners in the North American lithium market. We're also looking forward to further commercialisation of the ATA tailings through partnerships in mine tailings management. And again, I think this will be a big news story in the next few months. And finally, we expect to continue to grow our water treatment business, targeting about 25% revenue growth this year, and over 2023, that is. And we're going to enter into a number of licensing and partnerships in this area. For any further information, please refer to our website, which is www.cleantechwater.com. And we'll also have our latest webinar and ASX announcement there, and you can sign up for updates on the website via the contact page there. So thank you for your time.
Good morning, everyone, and thanks for joining me for this presentation. I'm Tim Dobson, CEO of Magnetite Mines, and I'm here to present our value proposition as a company. So we've spent the last couple of years restructuring our board and management to be timed for the development of the Razorback iron ore project in South Australia. Now, the timing of this project's development is critically aligned with the decarbonisation of the steel sector. Our project is very large. It will produce an extremely high grade of iron ore that will be essential for the decarbonisation of both domestic and international steelmakers in our region. The timing of our DFS is underway. We are already getting strong interest from potential strategic partners, and the South Australian government, where our project is located, is also highly attuned to this opportunity and is repositioning its policies around a green steel agenda for the future. So given the year that we've just come through in the capital markets, we find ourselves with a low market cap and a great position for new investors to come into the stock right at the right time for this story to play out in the development of our project. We've developed a company with a very strong and well-credentialed board aligned with the mining sector and M&A and corporate governance. And we've also got a very strong team both here in Sydney and in Adelaide, where our head office is, and our project office, to develop this project. The steel sector is going through a massive once-off transition. It's a growing industry, always has been and always will be. There's no known substitute for steel, and in fact, more steel will be needed for the energy transition into the future. But unfortunately, the steel industry is also one of the biggest polluters in the world, producing up to 8% of global carbon emissions. As a result of that, right back to the Paris Accord and through all successive COP meetings since that time, steelmakers have all come to the table and made carbon reduction mandates for themselves. And we are seeing that they are now acting on that, making investments in new technologies that will be able to decarbonise steel, that will need products such as we will make. So this graphic shows exactly how that will play out. At the moment, along the top of this graphic, we can see the steel industry uses blast furnaces and coal, coking coal, to make steel relatively cheaply, however, with a very high carbon footprint. To turn that into green steel, the only known technology that's been commercialised to date is to use electric arc furnaces. You can see that they're on the right-hand side as we go down the chart, and then to use direct reduced iron inputs and scrap inputs into those electric arc furnaces, which are run on renewable energy. And then finally, we get down to the bottom, which is the end game. That's to use only hydrogen and not even natural gas to do the reduction part of steel making. So this means that we can go all the way from iron ore through to steel without using carbon inputs. And that's what we call green steel. The key enabler is on the bottom left. Very high grade of iron ore is needed for this new technology to work. It cannot run on low grades of iron ore that are currently used in the steel sector. And this is where our Razorback product comes to play. It's what we call DR grade, direct reduction grade. And if we look at the outlook for DR grade materials, we can see that by 2050, there's going to be a big yawning gap in this between the supply and the demand in the market. That's clear on the chart on the left, produced by Wood Mackenzie, only in the last 2 to 3 weeks. On the right-hand side of the chart, you can see that the top left-hand corner is rarefied atmosphere. This is where DR grade lives. It's a very high grade of iron on the y-axis and very low level of impurities on the x-axis. We've plotted our project's concentrate grade on this chart, and you can see that we're well within that box, as opposed to most of the other iron ore production around the world, as we can see, does not meet that specification, that very high grade specification. So turning now to where we're located in South Australia. As I mentioned at the start, this project is in South Australia. It's very large, and it has caught the attention of the South Australian government. These magnetite resources have been known about for years and in fact decades, but only now has the economic viability come to the fore, based on premiums that will be paid for DR grade concentrates. And in fact, as we can see on the right-hand side of this chart, we see a great opportunity for value adding in the state of South Australia, taking those concentrates, turning them into pellets. That's a value add and achieves a higher level of premium. And then using the green hydrogen that this state will produce and has made a commitment to producing, and in fact being a leader in producing, to turn green iron ore into actually green iron for HBI, hot briquetted iron, for transport overseas. So these are the obvious and logical value-adding steps that we can see going forward. The state government is now forming a strategy around that will result in policy to support this decision. Looking at our project, we're 240 kilometres northeast of Adelaide. This photograph shows exactly what our ore body looks like. It's actually outcropping. These ridges are ridges of magnetite. We have 6 billion tonnes in mineral resources, and we have 2 billion tonnes of those in this actual ridge in the foreground that you can see, which is the Razorback Ridge combined with the Iron Peak Ridge in the background. There's 2 billion tonnes already defined in probable ore reserves. This is a soft siltstone hosted magnetite ore, very different than the West Australian hard rock magnetites, and as a result has a much lower input energy cost in terms of grinding. You can see here where the project's located, where it's called out Razorback Iron Ore Project. We've got a second tenement base off to the east in the same iron formation. It's called the Braemar Iron Formation. That's the Mustard Dam project with a further 1.5 billion tonnes in mineral resources. We're 50 kilometres from an open access railway line. This is critical infrastructure that already exists. We don't have to build our own railway line to get this product into market. That's a critical feature of where we're located. And we need to bring in high voltage power from the renewable energy grid that the South Australian government has built over the last several years. As you can see, we have 2 port options. Whyalla is an existing port that's running, or they're both existing ports, but Whyalla is an existing iron ore port that's actually already transporting iron ore off to global markets, and where there is capacity for our product to come through. Port Pirie is an even closer port. It's an operating port in an industrial town, and we see that as a logical location where the value adding will take place into the future. The economic viability of our project, we've tested that with Wood Mackenzie, who created a value in use cost curve. So this brings all of the world's iron ore production onto a single cost curve. Our first stage capacity at 5 million tonnes will be located in the second quartile in terms of costs. And as we go up to 10 million tonnes as the logical expansion stage, it will pull us down through the economies of scale into the first quartile. So a very viable economic proposition for this project and the concentrates that it will produce. We also know that having a very strong, robust foundation for ESG is essential for the project and the company that we want to become. And we've created our own brand for sustainability. We've called it Foresight, and we're already delivering key projects around stakeholder engagement into that. And and also identified the appropriate assurance standards and disclosure standards pathway that we will follow so that we're aligned with our customer base, which is, of course, downstream steelmakers into the future. So we've had a very strong and robust attention to our ESG platform. We're halfway through DFS studies now. If you look to the left of this diagram, you can see a series of technical and also approvals and other works that we've done in the last year. Looking forward now, we need to get our mining lease proposal in. We're planning to do that within the next 3 to 6 months, secure water supply, port access, and through to the completion of a DFS. As I mentioned at the start, we've had strong support from strategic partners in this project. So I spent a lot of my time in discussions with strategic partners. These are steelmakers and trading groups ahead of the steelmakers. We have a data room open at the moment. We have 10 participants in that data room as we speak, and are progressing their due diligence as we move towards transactional discussions. So just in summary, looking at our company and its value proposition, the timing of this opportunity is now, because the decarbonisation tailwind has now generated the demand for the product that we will produce, and that's into a decarbonising steel sector. Our project is large and it's in an extremely good location in South Australia. We're progressing it to development through a definitive feasibility study, and right now is a very good time to get into our stock, given that this year's capital markets have been closed and has resulted in us being timed right now with a very low market cap, that we will increase the gap between our market cap and our project value over the coming year with some new announcements. So thank you very much for listening.